Welcome to this explainer. Today, we're breaking down the precise GST rules for international sellers using data straight from the source material. If you've ever felt completely lost in that massive sea of tax compliance while trying to grow your global customer base, well, you're in the exact right place. We're going to unlock the cheat code to taxes, so let's get right into it.
Because let's face it, if you're an Indian small business owner, a freelancer, or maybe an Etsy creator, navigating the tax jargon of international sales, it can be incredibly overwhelming. You're hustling hard to get those global clients, but the paperwork, the endless acronyms, and honestly, just the fear of doing it wrong, it can feel like a massive barrier to your success.
Okay, let's kick things off with some genuinely fantastic news. Exporting from India is considered a zero-rated supply. Now, what does that actually mean for you? It simply means you pay a 0% tax rate. Plus, you're fully allowed to claim input tax credit, meaning you literally get back the taxes you paid on your everyday business purchases. And most importantly, it makes you eligible for refunds. It's a huge incentive. But yeah, there's always a catch, right? The exact rules, the specific conditions, and the actual paperwork required to navigate the bureaucracy and get those benefits, that depends entirely on what exactly you're selling.
So, to lower your anxiety around these complex tax codes, we're going to logically cover everything you need to know. We'll start with the zero-rated advantage, break down exporting physical goods versus services, put them head-to-head, explain LUTs, and then wrap up with some common mistakes to avoid. All right, Section 2, exporting physical goods, navigating physical borders and shipments.
The definition here is pretty straightforward. Export of goods simply means physical products are being sent from India to a foreign country. When you're dealing with tangible items that actually leave the borders of the country, and that could be anything from a massive shipping container down to just a single courier package, the government strictly classifies this as an export of goods. Now, the crucial point here is that you absolutely must meet 4 specific conditions. Check 1, the goods must physically leave India. Check 2, the supplier has to be located in India. Check 3, the buyer must be in a foreign country. And check 4, this is the absolute most important requirement, holding a shipping bill and the proper export documents is absolutely mandatory. Without that concrete shipping proof, the government just won't recognize your sale as a zero-rated export.
And this brilliantly illustrates how the rules apply equally across the board. It doesn't matter if you're a giant corporate exporter like SS Digital India shipping out 5 lakh rupees worth of steel sheets to a US company, or if you're an independent Etsy creator just sending a single handmade cushion cover to a customer in the US via a physical courier. In the eyes of the GST law, you are treated exactly the same under the export of goods category.
Of course, to prove your physical export and secure those sweet tax benefits, you need a very specific paperwork trail. You've got to generate a tax invoice, you need that vital shipping bill we just talked about, you also need transportation proof, like a bill of lading or an airway bill. You'll need an LUT if you're exporting without paying GST upfront. And finally, you need proof that the foreign payment actually hit your bank account, which is usually done through a Foreign Inward Remittance Certificate, or FIRC. Moving right along to Section 3, Exporting Services Overseas, the Digital Exporter's Guide.
Now, what's really fascinating here is how the focus shifts entirely away from physical shipping borders and instead focuses on the flow of foreign currency. For an export of services, there are no containers, no couriers. It simply occurs when a service is provided to a foreign client and, critically, the payment is received in a foreign currency. But make no mistake, it is heavily regulated. Under GST law, an agency or a freelancer has to carefully meet 5 exact conditions for their work to qualify as an export of services. The supplier is in India, the recipient is outside India, the legal place of supply is outside India, the payment absolutely must be received in a foreign currency, and lastly, the supplier and recipient cannot merely be establishments of the same person. You really have to check every single one of these boxes. To make this a bit more concrete, let's look at a couple of real-world scenarios. Whether you're a solo Indian graphic designer designing a logo completely online for a US client and getting paid in USD, or you're an entire Indian digital marketing agency providing SEO services to a UK company and getting paid in foreign currency, it all counts as an export of services. As long as that foreign currency arrives, boom, you fall right into this zero-rated pillar. Next up, Section 4, Head-to-Head Goods versus Services. Time to categorize your business model. This direct comparison shows us exactly where the lines are drawn. For export of goods, you're dealing with physical products. Shipment is a clear yes, and that shipping bill or courier receipt is strictly required. But for export of services, shipment is a no, and a shipping bill is not required at all. However, and notice this bottom line, for services, that Foreign Inward Remittance Certificate, the FIRC, is absolutely mandatory to prove your export actually happened. Now, this can get a little tricky for hybrid businesses navigating those gray areas. For example, sending physical products, like a carved wooden box to the USA, is definitely an export of goods. But the moment you start selling digital templates, that falls under export of services, or potentially ODAR, which is just the government's highly technical term for automated digital data services. Selling printable PDF downloads, that's mostly classified as a service or a digital supply. It's so important that you categorize each stream of income properly.
All right, Section 5, Understanding LUTs and Refunds, how to actually claim your 0% benefit.
Say hello to the most important document in your arsenal, the LUT, or Letter of Undertaking. Filed under the Central Board of Indirect Taxes and Customs, the LUT is essentially your golden ticket, your no-tax permission slip from the government. It allows you to export your goods or services without paying any GST upfront, completely avoiding the incredibly tedious process of claiming a cash refund later.
The source breaks this down into two distinct choices. Option 1 is using an LUT or bond. Here, you do not pay GST upfront, you execute your direct export, and you can still claim your input tax credit refund later. Option 2, well, that's paying the IGST upfront out of your own pocket first, and then going through the painful paperwork to claim a refund from the government later. I think we can agree, for most focused business owners, option 1 is definitely the smarter path to save your sanity and protect your cash flow. But keep in mind, depending on your pillar, your tax invoice has to contain specific declarations to remain compliant with that LUT. If you're a goods exporter, you absolutely must write supply meant for export under LUT without payment of IGST right on your invoice. If you're a services exporter, your invoice needs the client's foreign address, the specific currency like USD or EUR, your LUT declaration, and the correct SAC code, the service accounting code, for the exact service you provided.
Finally, Section 6, Common Mistakes to Avoid so you don't lose your refunds.
It's absolutely crucial to avoid these specific pitfalls. For physical goods, the top mistakes are a shipping bill mismatch with your invoice details, forgetting to renew your LUT, which, by the way, expires every single financial year, or simply putting the wrong GSTIN on your invoice. For services, it's even stricter. Accepting payment in INR, Indian rupees, can instantly ruin your compliance. Remember, foreign currency is mandatory. Other major service mistakes include not keeping proper proof of your foreign client or incorrectly identifying the place of supply.
Let's do a rapid-fire summary to really lock this all in.
Sending a bedsheet via courier to a USA customer, that is clearly an export of goods. Website creation for a USA client, export of services. Selling a printable invoice template on Etsy, digital service. Providing business consultancy to a foreign company, export of services. By categorizing correctly, you know exactly which rules apply. Which brings us to the most important question of all. Are you unwittingly funding the tax department with your own profits? Review your operations today. Make sure you're securing the right documents, filing your LOUTs, tracking your FIRCs, and definitely not accidentally leaving your hard-earned foreign income on the government's table. Protect your profits. Thanks for joining this explainer, and we'll catch you next time.